Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. Mcintire Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement. Northwestern Ohio, your resource for a common sense approach to planning, for guidance and perspective on your money, to help uncomplicate the financial and the economic world and the process of planning for retirement. He is Chris Mcintire, president and founder of Mcintire Retirement Services, always addressing some difficult topics. And today, Chris, on the program, going to be addressing some of the most commonly asked questions and maybe those issues that are top of mind for savers and investors right now.
Yep, absolutely, Peter. Good to be with everybody there today. And, it's been a challenging year here, as we all know. Stocks and bonds being down, lots of volatility, inflation coming up on midterm elections. So a lot of things that make people uneasy, Peter.
And indeed. And Chris, I think that when we feel uneasy, we tend to make the wrong decisions more often with our money. That emotional aspect of the decision-making process with our money doesn't always coincide with what is the best financial move to make. And so going to be talking about a few of the issues that can cause that emotion or can bring emotions out in us of worry and concern, and then how to address those through the planning process. But ladies and gentlemen, I want to remind you, while we'll talk about some issues and concerns that are on the minds of savers and investors on the program today, if you have a question on your mind, you are always welcome to be in touch. That's the value of this program, is that you've got Mcintire Retirement Services and Chris Mcintire as your resource that you can get personal direction and recommendations from. So if you would like to sit down for a strategy session or just ask a couple quick questions over the phone, pick up the phone and give Mcintire Retirement Services a call, 800-868-1194. That's 800-868-1194, 800-868-1194. So Chris, top of mind for savers investors, the market volatility that we are seeing, what's driving it, how long is it going to last, and how low is the market going to go? How bad will things eventually get here? I think are probably some of the questions you're hearing.
Oh, absolutely. Yeah. I would say there's a general lack of confidence in how people feel about the economics right now. And obviously, inflation, rising interest rates can certainly quell what has been a red hot real estate market, residential especially. As rates go up, it kind of prices more people out of the housing market, which keeps them in apartments, and apartment rents have been going up. So the whole inflation piece, it's like a hidden tax. And right now it's not so hidden. We see it at the gas pump, and prices have come down off their highs for now. And part of that was due to, China shut down and a quell in demand, but a lot of talk of rising energy prices. Oil will again be a factor as we head into the fall. And, Peter, it's hard to point it to one specific piece here, but confidence really is the underlying issue here. When people feel good, they obviously spend more money on discretionary items. So, when you start taking that part of the economy away, people start pulling back. It's kind of the snowball effect, right? I mean, that's how real estate prices got to go so well. Everybody was taking advantage of low interest rates. And then as interest rates go up, people start pulling back. They're paying more money on credit cards. They're paying more money for mortgages, car loans, things like that. Now, a lot of people listening today, my wife and I, we don't carry credit card debt. We pay it off at the end of the month there. Our vehicles are paid for. Our house is getting close to being paid for. But that's not the case with millions of Americans. Many of them are struggling to get, day to day. And if they can't make those payments, then defaults go up and bankruptcies and things like that. So, until they get this inflation animal under control, I think we're going to continue to see this crazy volatility.
And of course, Chris, you pay attention to the news. There's talking heads kind of on both sides with their predictions. We've sort of bottomed and we're going to recover from here, or it could get worse, much worse before it starts to get better. I think that's the real fear of the American public is are things going to get worse before they get better from where we are today? Really no way of knowing is the bottom line. So how do we set up our plans so we don't lose money unnecessarily?
Well, if we take a look at just stocks, for example, for right now, there are stocks in all different types of companies. And, our chief investment officer at Brookstone Capital Management is Mark Diorio. He's a chartered financial analyst, a CFA. And, he said, look, he says, yeah, people put money in the stock market, but you also have to look at this and say, it's a market of stocks as well. So we can pick what stocks that we want to be in. So, there are some low volatility type stocks that we have been utilizing right now for our clients. And they have certainly had less drawdown than, for example, some of the technology pieces, if you will. Amazon has been beat up, Microsoft, Google, a lot of the tech sector here, the NASDAQ, if you will, has had a very volatile year here, where some of the other companies like a Walmart, a McDonald's and, some of the staples where, look, Procter and Gamble, Johnson and Johnson, utility companies, I still have to turn the lights on. I'm still going to run my air conditioner. I'm still going to buy something that Procter and Gamble makes. I need to brush my teeth, Johnson and Johnson. So there are some defensive ways to play volatility right now. And those would be a couple of examples, Peter.
And it's not just stocks either. There are other choices and options in the financial world that we can begin to hedge or control the amount of risk that we're taking, right, Chris?
Oh, absolutely. Stocks can also pay dividends, which is one attraction to them. Look, I'm putting money in, I'm getting some dividends. As interest rates have rise, we've seen, even our fixed space of annuities, interest rates of, north of 4% coming right now. Hey, that's hard to find a 4% dividend or a 4% bond right now. So there are a number of different elements there based on, the person's general risk tolerance, their need to have access to the capital. We did recently a very short-term 3-year annuity for a client. It was 4%, and I'm not going to name the company in particular here because we'd have to do all the disclosures, but, you need to do your research, make sure that they're a highly rated company and, all the other ins and outs, the due diligence that goes with those. But, hey, the client was just perfectly happy and interest rates may continue to climb. So in a couple of years, they can probably renew that at an even higher interest rate, and they are very conservative minded. So they've been long-term clients and have never put any money in the stock or the bond market with us. They've always played it safe, and they keep coming back, and we keep helping them with those opportunities like we do for hundreds of people here in Northern Ohio.
Opportunities are available, ladies and gentlemen, depending on what your specific goals are with your money, what you would like your money to do for you. You can sit with a qualified, experienced professional, get perspective on the market, get perspective on these tools and options, weigh the benefits, weigh the pros and cons, and make sure that you are making a well thought through and informed decision with your money, and that you make that decision as part of a comprehensive, thought through plan. That is the key here, is that you do have a plan in good times and in more challenging times. And if you would like to get that plan put together, or if you've got a few questions about anything that you've heard or things that have been on your mind, pick up the phone and give Chris Mcintire at Mcintire Retirement Services a call, 800-868-1194. That's 800-868-1194. Chris, another big concern that people do have is running out of money in retirement. I know this is another one of those big issues that you help savers and investors, and particularly retirees, address each and every day there at Mcintire Retirement Services.
Absolutely. Who wouldn't want to get a paycheck for the rest of their life? And when you retire, you stop getting a paycheck. You have to create your own. Social Security would be an example of a paycheck for life. If you have a pension, that would be an example of a paycheck for life. We create a number of different types of income portfolios using stocks, bonds, structured notes, real estate holdings, that type of thing. And then obviously the most common one is using an annuity to give someone the potential to have a lifetime payment for the rest of their life. If they pass away, the spouse would get the same amount. In many cases, the ability to have that income increase over time. And then also to use it as a safe money strategy. There are different types of annuities. The traditional fixed annuity we spoke about earlier, where you get a guaranteed interest rate. We call them multi-year guarantees, MIGAs, Peter. There are fixed index annuities, which are also safe from market volatility, direct market exposure. So the worst thing that can happen is you don't lose anything, or you don't make anything. That's the worst thing that can happen in that case, relative to stock market performance. There are variable annuities, and Peter, that probably not the type of investment that I favor. That might work well for somebody who makes a lot of money younger in their earning years, if they need tax deferral and whatnot. But the cost and the inherent risks that go along with them just leaves a bad taste in my mouth. So personally, we don't use variable annuities. We use the safe type, the fixed annuity and the fixed index annuity. Many of them have the ability to give you a lifetime income while you still have access to some of the funds to allow them to grow as well. So it is not the annuity world of your grandparents, for example.
Chris, retirement enjoyment and quality of life, in my mind, comes from the ability to spend with confidence. Do you find that people are challenged in that aspect of retirement to give themselves permission to spend, with this fear of running out of money constantly looming and lingering in the background?
Peter, without a doubt, the clients I have that have the most peace of mind are those that have that guaranteed retirement income. And it might be Social Security and a pension. Maybe they don't need anything other than that. But those that have, guaranteed retirement income, knowing that money's coming in every single month, regardless of what is happening to their investment portfolio, are overwhelmingly the most comfortable when we get into volatile times like this. I could pick up the phone right now and call a client and say, boy, aren't you glad that you took that pension option that you did, instead of relying on, volatile investments? Or, aren't you glad that we created that lifetime income portfolio for you as a piece of your overall retirement plan, instead of relying on, growth in Amazon, growth in stocks, growth in, different types of bonds. And a year like this is a perfect example of why you want to have other alternatives than just the traditional stock bond portfolio.
Chris, I know inflation, another big factor, area of concern for all of us. I feel like we're in the middle of the proverbial rock and hard place kind of situation here. On one hand, we've seen the market volatility. We don't like taking losses. But on the other hand, if we were to sit our money in cash as a safe haven, even temporarily, with the kind of inflation that we are seeing, we end up losing value there anyway.
Yeah, we sure do. And I think we're in for a whopper of a cost of living adjustment for Social Security up and coming here. Might be one of the largest in Social Security's history from everything I've been reading.
Which will be a good thing for retirees, obviously.
Yeah, and it will, and the other side to that is, all right, their benefits are getting so great, it's hard to remove them from being taxed. So, are you really getting any more money, or are you paying more tax? But we'll talk about that on further shows as we get into fall, once that number's announced. And I think the inflation factor is going to hit people further on as we get toward the Christmas season here, the Christmas shopping season, because, over the summer, look, we've been locked up for about 2 years. There's a lot of pent up demand. People are spending no matter what. As we get a little bit further into this economic cycle here of a potential recession, rising inflation, that's when I think we could certainly see more pullback on spending. That's when people are going to, kind of tighten their belt, if you will.
How do we factor inflation into a retirement plan, Chris? On the day that we retire, we've got a finite amount of money. We try to cover our expenses, maybe not replace 100% of our working career income, but create enough income to cover our spending and expenses. But how do we try to plan and make sure that inflation and cost of living adjustments are factored in to all sources, not just Social Security?
Well, I'm going to answer this somewhat sarcastically here. So if I only use stocks and bonds and the traditional investment pieces, I would say, well, we're going to have to invest more in stocks to get higher long-term growth and whatnot, and then, and adjust accordingly for the withdrawal rate. Okay. The non-sarcastic, perfectly logical side of me would say, well, you would add an annuity to create that income. And, you can buy annuities with cost of living adjustments. You can have annuities that go up with with the rate of growth of the annuity every year and never go back down. So, that's the easy way to do it. And unfortunately, if we're watching CNBC, Fox Business, reading the Bloomberg channel, they're about stocks and bonds and investments and all of that. They're not about talking us into, hey, here's a real logical way to do all of this. And then we can cut off half of the talking heads we have on the show, but that's not the case, as you know. And I think that's my advantage to being an independent is, look, I want to use all the tools and resources that are available, not just the ones that are in the headlines.
Well, again, if you've got questions, concerns, things that have been on your mind, issues or areas that you'd like to give a little attention, pick up the phone and give Chris Mcintire a call, 800-868-1194. That's 800-868-1194. You can ask a couple quick direct questions over the phone or request the time for that complimentary review, evaluation, retirement planning strategy session. You can get the Mcintire Retirement Services proprietary game plan for retirement put together. This will help you address income, investments, taxes, healthcare, legacy, and many issues and subtopics underneath each one of those large issues, several of which we are talking about on today's program. But again, if you would like to take advantage, similar reviews, similar structuring of the plan can easily go upward of $1,000 to several thousands of dollars. But Chris Mcintire makes his time available here on the program, makes himself available as a resource to you, and makes the opportunity to get that plan put together available with no cost, no obligation. All you have to do is reach out to take advantage. 800-868-1194. That's 800-868-1194. 800-868-1194. So Chris, we are dealing with inflation. The June numbers sort of seemed to surprise the government. They were thinking that they would begin to keep that inflation number under control, and it came in higher than expected. I was not that surprised because I'm out in the real world paying for things every day, and I know they're getting more expensive. But the Fed's weapon to combat these inflation rates is to raise interest rates. Is this a good or a bad thing? How does this work? Will it work? What do we need to know about rising interest rates over this year and maybe the year to come?
Yeah, Peter, and I don't know that the answer is as easy as good or bad. The Federal Reserve, their job is full employment and inflation around 2%. And, as most of us realize that, inflation had been below 2% through the pandemic, after the and then for a prolonged period after the real estate crisis of 2008. Inflation wasn't a big issue. Interest rates were historically low. And then, all of a sudden we hit the pandemic and so much money was introduced into the system to keep the financial system from falling into a very severe recession, which they did. And probably overdid it by introducing too much money into the system. And then there are too few goods to buy as part of the supply chain crisis. So, to dissuade people from spending money, they raise interest rates. So if you think about the housing bubble of 2008, a lot of that was caused because it was easy to get money and take loans. So if they make that harder and give, money to qualified lenders, so to speak, then, you don't have that default risk. We're not going to have an inflation bubble. So I'm trying not to be too technical here on a radio show, but, the Federal Reserve only has so many tools. And one of those is, what is the cost for banks to loan money to one another, which then what's the cost for us to borrow money from banks?
Chris, there's a saying in the financial world that history does not repeat, but it often rhymes. And I feel like right now is one of those times where history is rhyming very closely. If you look back to the late 1970s, early 1980s, inflation was running away and getting out of control. So they raised interest rates significantly. I mean, we were talking the mid to upper teens as far as interest rates, and it caused a pretty steep recession in the stock market. Prices were depressed for some period of time. And I feel like we are in a similar kind of set of conditions and scenario right now. Maybe the difference is that back in the late 1970s and early 1980s, being an investor was not as common for average Main Street Americans. That really didn't become commonplace until the adaptation of the 401k. That's when many of us actually became Wall Street investors. So maybe there is more at risk and on the table as this market has experienced challenges because of these other conditions that we are trying to control and adjust.
Yeah, it's a good point. And, I'm 57 years old, so I remember the 70s and the 80s and, how lean, they call it stagflation. We really didn't go anywhere, and how we fought ourselves out of that. And I think, the Federal Reserve Chairman, Jerome Powell, certainly is a very highly educated person, and he can look back through times and see the mistakes that were made in the past to hopefully not repeat those mistakes here in the future. And you've seen that by how fast they've raised rates. They want to slow the economy down without throwing it back into a recession. And I mean, that's a tough dance to do. Let's be honest, because still has supply chain issues, I suppose the good news side of this is that, the employment picture looks very good yet. And, gas prices have come down here through most of July. Maybe that will help quell some of the inflation number here going into August and September, and things, will be getting less worse. Maybe that's a way to describe it. I don't know if we're there to say things are going to get better, but less worse and more predictable here, because I think the inflation came so fast. It caught a lot of people off guard. Transitory was what everybody was saying in the administration. And, let's be honest, you got an important midterm election up and coming here, which the balance of powers in Washington are at play, and that's very important. So if I was on the one side of politics, I would want to get things taken care of as fast as I can before, Americans with very short memories, walk into a voting booth as well. So we may see some more action come down the road to make it less worse, is my analogy, Peter.
I like the less worse. I'd like things to get better, but I'll take less worse at this point in time, Chris. Another thing, though, I think that with history kind of rhyming, except this time being a little different, is that back in the late 70s, early 1980s, when they raised interest rates, Chris, Americans were at that point in time more savers. And today we've got a society where many of us are in debt. And so those interest rates being higher during the period of the mid to late 80s was actually, except for the mortgage balance, really a benefit to many Americans. Whereas today, without that savings that we once upon a time used to do, and with debt instead working against both us as individuals and us, US, as a company, or I mean, as a country. Sometimes you can get confused as to which is which, but with the national debt and with the amount of personal debt people have, these higher interest rates or rising rates, again, maybe kind of a difference that is more problematic than it was in previous examples where we were in kind of similar conditions.
Yeah, no question about it, Peter. If these interest rates go too high, people that have adjustable rate mortgages, for example, there's some bad things that could come out of that potentially, and we don't want to see that, because no one wants to see anybody lose their home. file bankruptcy off of credit card debt. And it happens, here we live in a somewhat free society, and it's easy to get yourself in a pickle. And, for millions of Americans, that happens. And the other side of that, for the investor side of me, is, when, somebody takes a mortgage, many times those mortgages get sold off and get put into bond funds down the road. Okay. And so there's a lot of risk with that. A lot of that credit card debt can also get sold off and put into different types of investment vehicles, right? High yield bonds, junk bonds, for example, mortgage-backed securities. So if that default risk gets too high, you'll see some volatility more in those spaces as well. So, there is it is a fine line that the economy is in right now. And, can the Federal Reserve, kind of keep us out of tipping into that recession side of things? And it's look, if I'm a politician wanting to get elected, I'm going to be saying the recession word as much as I possibly can, because that's an emotional element. And that's how you started the show today. People are emotional about everything going on right now. Not everybody's real logical, right? A lot of people think that, hey, you may see rates come down next year, which means those bond prices are going to come up significantly as well. And, there is opportunity, in anything that's going on right now. What we have done at Mcintire Retirement Services is shortened our bond duration and gone into, very, very short-term paper, we would call it, to mitigate that interest rate risk. We've gone into lower volatility type stock holdings and ETFs, if you will, exchange traded funds, to help mitigate some of that risk. Dividend stocks are doing well. We've been in a significant growth stock market driven by Amazon's, Google's, that type of thing, where they don't pay dividends, but, we're in them for their stock price to go into more of a value stock. After the market has fallen 20 to 25, 30%, boy, there's a lot of good quality companies on sale. We call that a value play. So it is turning into a value stock market versus a growth stock market. And that's happened over the course of 2022, Peter, if I hopefully made an analogy there.
Yeah, but we know that things are cyclical in nature, and things will come back around. Certainly, we have not answered and addressed all of the financial questions on this program, but there are resources out there, ladies and gentlemen. Chris Mcintire hosts this program, Your Game Plan for Retirement, on a weekly basis. We've got the archives with shows on almost all the financial topics that you could imagine. And if you go to McIntireRetirementServices.com, you can find those resources and those archives there. He's got reports, tools, and calculators on the website. And most importantly, he makes his time personally available to you. If you've got questions or concerns, then give a call. Ask those questions, get the answers that you're looking for specific to your situation. Come in for that planning, review, and evaluation, that strategy session, and to design your game plan for retirement. 800-868-1194 is the number to call. That's 800-868-1194, 800-868-1194. And Chris, not everybody knows about all of these factors. Not everybody pays attention. Not everybody wants to do the worrying about their investment portfolio and the various tools that they have there and how everything's working and how it's going. And I think that for those reasons and more, that's why it's important to have a resource that we know, like, and trust. And we appreciate your time and perspective here on the program and giving us the guidance that we need to navigate this complex financial world.
Thanks, Peter. I'm happy to be here with everybody. And, I know this isn't a very fun year for most of the investors out there. There are other alternatives for you to consider. Give us a call. We'd be happy to help you.
They are your local resource, ladies and gentlemen. Northwestern Ohio savers and investors have relied on Mcintire Retirement Services, their individual comprehensive planning with a fiduciary perspective and responsibility. If you would like that for your situation, again, just to get questions answered, or that plan designed and implemented, or a review and spot check, double check up on your current plan, pick up the phone and give them a call. 800-868-1194. That's 800-868-1194, or visit online, McIntireRetirementServices.com. Chris, once again, always a pleasure, and we appreciate your time.
Hey, my pleasure, everybody. Stay safe out there. Thank you for listening today.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement.
The content of this radio show is
Be
provided
sure
for
to
informational
subscribe.
purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.